In this video, we will see if Xcn coin will break out. Please watch until the end to understand and not to miss anything. There is a downtrend clearly visible on the chart, and the price is currently moving close to this trend line. Breaking this downtrend would be a crucial step for the price to break free from the downward pressure and enter a new bullish wave. Downtrends usually indicate that the market is controlled by sellers and the price is moving downward, pressured within a certain channel. However, if the price can break above this trend line, this could be a strong signal that the trend may change. Especially if this breakout is supported by high volume, we can expect the price to reach higher levels. After the breakout comes, it should make a retest, and then it will be ready to rise and make the breakout. But it is wrong to look only at the trend breakout. You need to look at other metrics. So keep watching. A bull order block just below the price stands out as a strong demand zone identified by market makers and large investors. Bullish order blocks are usually found at levels where the price has already made an upside breakout and is likely to face a strong buying reaction when the price returns to these levels. Currently, the price is hovering quite close to this zone, and if the selling pressure continues, it is likely that the price will touch it. If there is a strong buying reaction when the price reaches the bullish order block, it could indicate that this area is being actively defended and buyers are trying to take control. You see how many times it has reacted here. The bear order block on the upper side stands out as a critical area where strong selling pressure is building in the market. It represents an area where the price has been bullish in the past, but has faced heavy selling, thus becoming a strong resistance level. Bearish order blocks are often known as areas where big players are selling, and when the price reaches it again, it may face similar selling pressure. In the event that the price moves up from its current level, it is likely that this bear order block will be tested first. If the price encounters strong selling when it reaches here, it could indicate that this area is still actively defended and sellers are not giving up control. In this scenario, the price is likely to make a downward correction move from here again. After breaking and retesting the trend, its first target will be this bearish order block. According to Elliott wave theory, there is a cycle of 5 major waves in price action, and the third wave of this cycle is actively developing. The first 2 waves have already been completed, and the third wave is usually the strongest and most prominent. In technical analysis, the third wave should advance to the 1618 Fibonacci extension level as a minimum. The first wave is usually the first move where the market starts a new trend, and the price gains a small upward momentum. Then comes the second wave and a correction move takes place. The second wave usually develops in the form of a pullback as traders take profits, but this correction never goes below the starting point of the first wave. The third wave comes suddenly and is the longest wave. And people panic buy when the third wave comes. So the third wave should come in at a minimum of 1618, but it could go to higher Fibonacci levels. The main reason for this bearish move on the chart is the shoulder head and shoulders pattern that formed at the top. The shoulder head and shoulders pattern is a reliable technical analysis pattern that usually indicates the end of an uptrend and the possibility of a trend reversal. This pattern consists of 3 main components: the left shoulder, the head, and the right shoulder. First, on the left shoulder, the price rises, then retraces, peaking at a certain level. Then the head is formed, where the price makes a higher peak than the top of the left shoulder, but falls back down. Finally, the right shoulder forms and the price makes a downward move again before reaching the peak of the head. The most critical point of the pattern is the so-called neckline. The neckline is a horizontal or slightly sloping line connecting the left shoulder and right shoulder bottoms. If the price breaks this neckline downwards, the head and shoulders pattern becomes active and the bearish expectation becomes stronger. In this case, the price is usually expected to fall by the height of the head. This is exactly the main reason for the current decline on the chart. The shoulder-to-shoulder pattern formed at the top zone was completed, and the price broke the neckline and started its downward movement. Technically, this breakout indicates that sellers have become dominant and the market has changed direction. If the selling pressure continues and the price does not reach the target level of the pattern, corrections may occur, but the overall trend may remain bearish. It is necessary to follow such patterns so that we can learn the direction of the trends. There is a prominent ascending channel structure on the chart, and price movements within this channel are remarkable. Ascending channel patterns are important technical structures that usually indicate that the price is moving in an uptrend and may continue to do so. Currently, the price is experiencing an upward reaction after touching the lower band of the channel. The lower band usually works as a strong support level, and when the price hits it, buyers react by stepping in. With this reaction, the price turned bullish, and is currently moving between the lower band and the middle band of the channel. Price action in the ascending channel is usually evaluated against two key levels. The lower band works as support, while the upper band acts as resistance. The price moves up with support from the lower band and may show some hesitation or indecision when it reaches the middle band of the channel. If the buyers remain strong at this point and the momentum continues, the price is more likely to move towards the upper band of the channel. If the price breaks the downtrend, it moves towards the middle band. There appears to be a significant tightening of the Bollinger Band, and this tightening usually indicates that the market is in a decision phase. However, this narrowing cannot last forever, and is usually a precursor to a strong price move. At the moment, the Bollinger Bands are quite tight, suggesting that a big move in the market is just around the corner. This squeeze may signal a period when investors and traders are indecisive, and the price is stuck at a certain level, trying to determine its direction. In such situations, it is common for the price to move sideways at current levels and for volume to fall. However, the longer this squeeze lasts, the more violent the subsequent move tends to be. There are usually two scenarios following a narrowing of the Bollinger Bands. Either an upside breakout occurs, and the price makes a bullish move to the upper level of the bands, or a downside breakout occurs, and the price enters a downtrend. Therefore, the breakout of the current squeeze is of great importance, but the price is currently above and we can expect a breakout to the upside. When we look at the MACD indicator, we can see that a crossover from the downside to the upside has occurred. This type of crossover usually signals a bullish momentum shift. When the moving averages of the MACD start to cross each other from the downside to the upside, it indicates that the market is starting to gain strength and buyers are taking control. Currently, the MACD line is very close to the 0 point. In technical analysis, when the MACD moves above the 0 level, the bullish momentum gains a stronger momentum. This is because movements below the 0 line usually indicate bearish markets, while a break above it indicates that the uptrend is gaining strength. If the MACD breaks the 0 level to the upside, this confirms that the market is bullish and buyers are gaining more strength. Once the MACD crosses above the 0 line, the price will have broken the downtrend. Looking at the RSI indicator, there was a long-standing falling trend line. The RSI has broken this downtrend, giving an important technical signal. Usually, trend breaks in the RSI are a leading indicator that a similar breakout in price action may occur. After this breakout, the RSI performed a retest in accordance with the rules of classical technical analysis. In other words, it tested the trend line it broke once again, but continued to rise with support without retreating below this level. The fact that the RSI returned to this level after breaking the trend line and received confirmation as support shows that the bullish movement is on firmer footing and price movements may follow a similar structure. And as the RSI breaks the downtrend, the price will most likely break the downtrend because the RSI and price move at the same time. On the vortex indicator, when the blue line is above the red line, this usually signals a bullish situation. The vortex indicator is an indicator that measures buyer and seller pressure in the market. The blue line indicates strong buyer pressure, while the red line indicates strong seller pressure. In the current situation, when the blue line is above the red line, it indicates that buyers are more dominant in the market, which signals an upward movement of the price. And if the blue line moves even higher, the bullishness will grow even more. And on the 30-minute chart, the price is now touching 200 EMA. If the price breaks the downtrend, it may ensure to stay above 200 EMA. Above 200 EMA means a longer uptrend. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.